the Blackstone Real Estate Investment Trust, or colloquially referred to as the BREIT. And what this is, it is a non-traded REIT sponsored by Blackstone and run by Blackstone's real estate investment professionals. And the way that works is, Blackstone receives management fees as the sponsor, in addition to like a promote structure, et cetera. And they use those fees similar to the other family of, broader private equity funds and any other investments that they manage to support their own dividend distribution to Blackstone shareholders. So that's kind of the structure. But this REIT, it's possible to have private non-traded REITs in addition to public REITs. It's just the tax structure, right? So this thing kind of sits in the middle of Blackstone. And there are rules written into the fund docs. It's basically a closed-end fund, similar to any fund, that dictate the holder's rights as well as the manager's rights. Well, to my understanding, when the net redemptions in any quarter hit 5% of BREIT's NAV, it provides the sponsor as Blackstone with the right to put up the gate for the following quarter. Conceptually, the problem here is that like you're investing those proceeds in a relatively illiquid asset class in the form of real estate, right? So like if you buy a $2 billion office building, or which they have done in the case of Hudson Yards, for example, or you buy a APTS or a BRG, you can't really, like, if you have redemptions that you have to meet, you can't really just turn around and liquidate that immediately, right? Like there's a sale process, the markets may be illiquid, et cetera. And what's really interesting here is that whole NAV concept that determines their right to put up the gate. It's based upon Blackstone's own marks. So there were stories over the summer where, obviously as we saw, public REITs were down 20, 30, in some cases more, higher percentage. And Blackstone was still marking up their NAV, which clearly didn't make any sense. And my thought is that like they kind of were in a position where they had to do that and push it as far as they could, because if they took a true mark, it would immediately trigger the gate and freak out the market. Well, we're now at that point, and I think there's a possibility that you could get like a rolling kind of gating of the fund, so to speak, quarter to quarter. As the real estate markets valuations decline and they're forced to mark these things down. Well, just to put a cap on it, that has really, really negative read across or implications for the broader real estate market, especially these like larger, chunkier, illiquid transactions. A lot of times, if you talk to brokers, BREIT would be the only company to show up and bid for some of these larger transactions. So like the marginal buyer with liquidity is now out of the market. And by the way, other funds such as Starwood sponsored, closed-end fund are doing the same thing now. So it's kind of a disaster.
Kind of a disaster. I mean, this is, again, it's like a very large and obvious canary in a quad 4 coal mine with a regime shift in interest rate policy and how real estate is valued in America, and housing for that matter, at the household level. It's all interconnected in the same thing.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.